Bloomberg Audio Studios. Podcasts, radio, news.
And this week, you might remember, Goldman Sachs came out with a note saying that the streak of blockbuster gains for the S&P 500, it might be over. And they say that we'll only see around annual gains around 3% over the next decade, compared to the average 13% over the past decade. And we are joined now by Goldman Sachs Chief U.S. Equity Strategist David Kostin, who led that call. He joins us now. When you think about this call, very controversial, David. And so I am very curious about kind of what the caveat is here. Is there kind of any upside that could be squeezed out of the equity market that is outside of this base case?
So let's talk about the base case for the next year, and then we'll look at the base case for the following 9 years for full year, decade of performance. So the next year, we're looking at the S&P 500 rising around 8%, 9% total return to an index level of around 6,300. And the thought process behind that is the U.S. Economy is growing, inflation's coming down, the Fed is cutting rates, earnings are growing 11% in calendar 2025 and another 7% in calendar 2026. And that sets up with a valuation today of around 22 times earnings, slight compression in the multiple. That is the building blocks to a return in the next 12 months of roughly 9%. So what we focused on in this report was what's the probable total return that an investor should anticipate for the cap-weighted S&P 500 index. And the conclusion was a range of somewhere between -1% and +7%. Midpoint of that is around 3%. What is the driving force behind that thought process and that analytics? Well, there are two issues. The first is valuation. We know when the market trades at a high multiple, a high valuation, that the next 10 years is typically low relative to an environment where, say, the multiple is low at the beginning. You tend to get a pretty strong return in the subsequent decade. So we're sitting here with a cyclically adjusted PE multiple that's different from a forward one-year multiple, based on the cyclical adjusted earnings for the last decade of 38 times. That's the 97th percentile versus, say, the last 100 years. So it's a very, very expensive starting point. And what's new about the analysis is that we also include a variable for concentration. We're in one of the highest concentration markets in 100 years. Top 10 stocks, for example, comprise around 36% of the index. It's an extremely narrow concentration. And historically, when you have a high concentration market, you have a relatively muted return in the subsequent 10 years. Now, valuation and concentration are two different variables. They're not correlated. And so there's two different influences as to why we get a lower, relatively modest return. Yep. Now, what are the implications for a portfolio manager? Matt, the way you want to think about this is equal weighted. The equal weighted return is likely to be probably 500 basis points greater. So instead of 3% for an aggregate index, something like 8% for the typical equal weighted index. And so that's the conclusion of the report.
Well, but the concentration is in, I think, very many global champions, right? I mean, you have companies that dominate their spaces globally. Plus, we've got a few that are likely to come on board soon. SpaceX, for example, OpenAI may go public in the next decade. And if I look, David, over the last decade, I actually stole this chart from DataTrek, as I've pointed out before, but the only time that we've had 3% returns has been when we've had catastrophic events, the Great Depression, the oil shock, the financial crisis. Do you expect something like that to come again over the next decade?
No, what we're anticipating is a broadening of the market, the relative performance of the typical stock versus an aggregate index. What we're focusing on is a strategy for how to perform well. When we deal with some of our largest institutional clients, sovereign wealth funds, pension funds, endowments, insurance companies, family offices, when they think about a 10-year horizon, they think about asset allocation, where are the risks, and the idea of a very concentrated market is what tends to be a risk that gets introduced, and that is the emphasis of this report, and that's the thought process, that's the analytics behind it, and the model that we build. We look at rates, we look at the economic environment, we look at the profitability and the ROE of companies, and so all of these variables at the index level relative to the typical stock, that's how we get to a conclusion that it's a better strategy, a better return strategy from our perspective, with a equal weighted strategy.
Well, David, I want to talk about the cross-asset nature of this call, too, because you say that it's likely that bonds are going to outperform in this environment. But reading through this call, I mean, if you're not calling for a recession here, I assume the Fed doesn't cut rates back to zero. Wouldn't this be a call for cash? Aren't cash yields going to stay relatively high and you don't have any credit or duration risk there?
Well, I mean, there's other strategies. You could look at private credit. You could look at private equity as a potential way of diversifying a portfolio. Relative to right now, the idea of treasuries, 10-year treasuries yielding 4.2%. So if you were to start today and look out with our centerpiece of or the central case of our forecast, something like 3%. But if you look at the distribution, look, the idea of being at the high end, there are a lot of reasons why you could be at the higher end of our range, closer to 7%. Matt identified a couple of those. You typically get around 3.5% of the constituents in the S&P 500 turnover every year. So we look out for a decade, you're probably looking at a third of the index. There's going to be new stocks that don't exist today in the index. So there's certainly a lot of variables that could happen. The economy could be growing more rapidly, more slowly than a baseline forecast. Those are their issues. AI, in terms of artificial intelligence, could raise productivity. I mean, lots of reasons why it could be better than our base case scenario, which is why we have a range to the upside and the downside.
One thing that struck me in this note as well is a 1/3 chance that you have the S&P 500 lagging inflation through 2034. What's the role of inflation here? And what is the risk that it could be higher? What if the neutral rate is higher? What kind of impact would that have on equity market returns?
Well, so you think about inflation right now, the TIPS break-evens are around 2.2%, for example. And so based on a scenario where you have a return that could be negative 1% annualized versus positive 7%, kind of there's a distribution around that, relatively normal type distribution, the part tail of the distribution would give you a prospect of a return that's less than inflation. That's not the base case, but it certainly is a scenario. When we deal with portfolio managers, they want to think about what are the risks that are introduced into their portfolio. And the argument behind a broadening of the market is an important construct. So one of the arguments on why mid-cap stocks are likely to do better than the rest of the market in the coming year. They have the best torque to the idea of the Fed cutting rates. They got 25% of their balance sheet is floating rate. So you have the Fed cut rates. They have less interest expense. They have higher earnings. Positive earnings revisions drives equity prices. And so those are tactical issues, opportunities in the market. So we think about tactics, we think about strategy longer term, and that's the purpose of writing the report in response to questions from clients about how should we think about the prospective 10-year forward returns in the equities. Right.
David, we don't have a lot of time left. I know I have a question. I know that Matt has a question as well. So let me ask you this quickly. I want to get existential about the business that you're in, because you think back to January, and actually Wall Street strategists on average were expecting the S&P 500 to rise about 2% this year. It's up 23%. And I'll flip the question to you. Is it getting harder to model, to forecast where the index is going to go?
Well, it is challenging because a third of the index is comprised right now of about 10 stocks. That's not just tech stocks. You have some healthcare stocks, Eli Lilly. You've got Berkshire Hathaway's in the top 10 companies, for example. Depends on the day we're looking at. It could be Visa, Broadcom, different constituents, along with the big tech companies that we're all familiar with. And so it's challenging to look at the market that's that component, and you can look at the rest of the balance of the market. So you think about those big stocks. They trade at 31 times earnings. That's a 2.7% or so earnings yield. It's a negative risk premium versus 10-year treasuries. So that's a concern about valuation. And then you have the concentration item that I overlaid. The rest of the market has a positive risk premium versus bonds. And so that's one of the attractive components of why there's a broadening of the market and why we anticipate that to persist.
David, I have an election night question for you. When you get get home, put on your slippers, grab a scotch and your pipe or whatever, and you settle down in that lazy boy, right? Click on Bloomberg TV. What are the indexes or the assets, or what are you going to be watching on election night as we hopefully get a clearer picture of who's going to occupy the White House in the next 4 years?
Well, the election is obviously quite close in terms of the polls and things like that. So I think there's a couple things that we look at. First, is there a split Congress versus the presidency? That would suggest there's certain executive actions that can be taken, whether that's respect to tariffs, whether it's respect to certain regulation aspects that the presidency, he or she, could implement. Whereas if there's a sweep on the Democrat or the Republican side, either direction, there are potential legislative aspects. So, Matt, that's sort of the first question I want to think about. The second is we think about, well, what are the impacts of potential tariffs? What would they be? Well, U.S. companies that are selling domestically are likely to outperform U.S. companies that export more to the rest of the world because there could be retaliatory tariffs. So that's one strategy that we might look at. We might look at companies that have that sort of executive authority that you might want to think about. And then we would talk about that with portfolio managers. And there's baskets that we trade on Bloomberg with clients based on those two characteristics.
All right, so it sounds like you have a lot to keep an eye on. We all do, and we really appreciate you taking the time today to walk through that call heard around the world. That is Goldman Sachs Chief U.S. Equity Strategist, Dave.